Hey guys, welcome to another video in the Refine series. Today we'll be talking about Orderflow, and we are going to be linking this in line with liquidity. And the aim of this video is to drive at building a framework at which you could look at the market every time you come open your charts. Because you see, if you don't understand what I'm about to show you now, you always look at the charts and don't understand why it is moving up and down, sideways, and this could really turn you off and you just end up getting frustrated, depressed. And if you're already intermediate in your trading journey, you also need this video, because this video is going to build on the knowledge you already have to spur you up to your growth and possibly direct you towards what is missing in your trading. But if you implement this, your trading could see significant growth in the next few weeks. Okay, so they normally call this the power of three. Okay, the power of three concept. And it just simply means accumulation, manipulation, and distribution. Why are we talking about accumulation, manipulation, and distribution? Before market moves up or down, right? We want to see this sequence occur. We want to see this sequence occur every time price either goes up or price goes down. Okay, so the accumulation part is price accumulating orders, generating orders. Okay, so yeah, the institutional bank, the algorithm accumulates order. This is always signified by consolidation. So you know that phase we talked about in market structure, where market is moving sideways, neither going up nor going down. What is usually happening during those seasons is that price is accumulating orders. Okay, they are stacking orders. And then after that accumulation, what we will normally want to see is a manipulation. Okay, we want to see manipulation, and then we want to see distribution. Okay, so if it is in a bullish environment, we want to see manipulation downward, then a distribution upward to the accumulated buy side liquidities resting above all these highs. Okay, that's what we want to see every time we look at the market. But you see, you can't understand this if you don't understand market ranges. So what is a range? A range is basically when price sweeps. Okay, so let me do this. When price sweeps a high here, in this case, and sweeps the low that created this high, the range between this high and this low, this new low created here, becomes the range, becomes the new range. So we have price sweeping this high, breaking below this low. This is the low that created this high. When the price does this, the range from the high to the low becomes the new range market has formed in this sequence. And you can always use up Fibonacci to, you know, everything above here becomes premium. Everything below here, everything below becomes discount. So this is in a bearish scenario. So what do you want to see? You want to see price trade into premium. They want to see price trade off. Why? Every seller wants to sell at a higher price, and every buyer wants to buy at a lower price. Now let's bring that down to a bullish scenario where we have price put on a low, right? Creates a high, sweeps this low here, breaks this high that created this low. The range between this new high created here and this old low and this low here becomes a new range. So price swept this low here and broke this high here. So what the price basically did, price came manipulated, put in a fake move low, then broke above this high, which is a block of structure. Immediately this block of structure is confirmed, the range and price starts returning into the range. The new high created and this new low becomes the new range created. So what do we want to see price do? We want to see price retrace into discount arrays. We talked about PD arrays in our video, so go there and watch all the PD arrays we've released so far. So want to see price trade into discount, right? And after price trade into this discount, we want to see price trade higher. So in a layman term, what we are basically saying is price moves from external range liquidity, takes out external range liquidity, breaks this low, break of structure, price return into the range, right? And then we want to see price break out of the range again by taking out this low. Why? In a market structure, remember, in a bearish market structure, we want to see highs getting rejected and lows getting broken. In a bullish environment, we want to see lows getting rejected and highs broken, right? So that's the sequence. That's the sequence you always want to see in both a bullish and the bearish market. But you see, price is not always going to be going up all the time, neither is it going to be going low all the time, right? So what do price basically do? Price consolidates here. Now inside this structure, we have little minor structures like this. But this is going to be a topic for another day. We'll talk about it in our next class. We'll talk about internal, external range liquidity. But I want you to understand this power of three concept, which is a unique concept that can change your trading game for good. So we want to see price accumulate, right? And remember, this is a bullish environment. This is in a bullish environment, and we want to see this happen. We want to see price manipulate lower into a discount key level. Now, what is a key level? A key level is simply a higher time frame PD array, right? It could be an order block in the higher time frame, fair value gap in the higher time frame, a low in the higher time frame, a breaker block in the higher time frame, mitigation block and rejection blocks in the higher time frame. Any PD array formed in the higher time frame is regarded as a key level. So when price manipulates lower, we want prices trading low until it meets its target. That target is always mostly a key level, which is a higher time frame PD array. And as soon as price trades into that key level, we want to see price trade off of it, reject off that key level, right? Break structure, on the lower time frames, and then we see price target the highs as the buy side liquidities, right? Buy side liquidity, because in the bullish market is rejecting lows and breaking highs. So accumulation, manipulation, distribution. Likewise, in a bearish environment, so we want to see price accumulate, trade higher. This movement higher is a trap for buyers who will keep on longing trades until price meets a key level. You can participate in this manipulation leg if you are really good, but you want to always be in line with the trend as a beginner, right? So in this manipulation leg, price puts on a fake move high, deceiving traders to believe that we are trading higher, but price trades higher until it meets a bearish key level. And as soon as price meets this bearish key level, price rejects off of this key level, right? Put on a reversal pattern, which is break of structure, which is into a premium array during this leg low, and then price targets all the sell side liquidities resting below these lows. So that's what we have: accumulation, manipulation, and distribution. And this is the sequence in every bullish and bearish market. This is always the sequence in every bullish and bearish market. Now, how do we know when price is about to reverse? That will be a topic for another day. But I want you to understand that this is the and to understand this order flow properly, it you must have a detailed understanding about time and time-based liquidities. I have made a video of on time-based liquidities and liquidity as a whole on this series on the YouTube channel. So you might also want to go check that out as well. Okay, you want to go check that out as well. It will be on your screen, so you just want to click the link on your screen to take you to the liquidity video where you can understand why I call this a buy side liquidity and I call this a sell side liquidity, and how price reacts to these liquidities as they draw on liquidity. Because you see, in a bullish market, you want to first of all pick out where is the market drawing to. That's the question you want to ask yourself. Where if this market is going to be bullish today, what is the likely target for price in this bullish market? And once you mark out the drawn liquidity and price puts in this manipulative leg low into a key level, you want to position yourself during this leg up until price meets the presupposed objective of the day. And in the bearish market, you also want to figure out what is the drawn liquidity for today or for this week or for this month, depending on the type of trader that you are. And once you figured out the drawn liquidity, which is low, right? You want to find entry positions during the leg down until price meets its draw on liquidity, meets its target. Okay, that is what we're basically doing. That is the whole essence of what we're doing in the market. When you understand the power of trade concept, it becomes easier for you to go into your charts and wait for the time market presents itself to you to participate in the distribution. So as a trader, you want to always participate in the distribution leg, right? Very few times you could find good opportunities to participate in the manipulation leg, right? But this will demand a lot of experience. And if you're a beginner, you don't want to be playing around in the manipulation leg. Just wait. Exercise the patience and wait. Wait for price to put on the reversal signatures. You can join enter on the continuation leg, right? On the continuation leg, which drives price higher. You don't even want to be playing around these zones. These zones. You don't want to be playing around these zones. You want to wait for price to give you a clear indicator that we are moving higher, which people most times this you see here is almost always matched with this three candle pattern. Shout out to Romeo. Why Romeo? Not just Romeo, but I like to give credit to Romeo because he made this. This was an ICT concept all this while. But you see, Romeo made it very, very visible to the layman. And we must give credit to him for that. Okay? We must give credit to him for that. So what I'm trying to explain is that this accumulation, manipulation, distribution is always is always a sequence in the market, and you can easily recognize this pattern using this three candlestick pattern I'm drawing out currently. Apologize, this is taking a lot of time, right? But I want you to understand the concept properly. So this is this is accumulation, right? This is the high of the first candle. This is the second candle, which is the manipulation candle C2, right? Price sweep, the liquidity resting below the C2 candle. Okay. As soon as price sweeps the liquidity resting below this is where you don't want to participate, because if you are a beginner trader, you don't want to participate here. And this is that leg I talked about around this zone. Where you want to participate is this leg upward here. This leg here is the candle 3 distribution. It's way easier for you to pick out your setups in this candle 3 than to pick out your setups in the candle 2. Why? Because this is the manipulation leg, and you reverse engineer this for the for the bearish setting. Okay, so accumulation, manipulation, distribution. So let me change this. Accumulation, manipulation, distribution. Reverse this for a bearish scenario. Okay, so I hope this video introduced to you a powerful concept you could go on your chart to look out for. Okay, so I just feel like many people are asking me, can you show me chart example? Let's go. Look at this. So this is accumulation. Can you see that price was accumulating during this time window from 13 o'clock down to 20 o'clock, and then price manipulated. Okay, and then we see price distribute. Is always the sequence all the time. Is always the sequence all the time. And as price began distribution, where was the target for this distribution? This buy side liquidity resting above these highs, and price came, manipulated, consolidated, manipulation, distribution. What the target? Buy side liquidities. Okay, so we're going to look for a bearish scenario. Okay, this is a perfect example. Okay, so we have price consolidate from 2 o'clock to 6 o'clock. Okay, New York time. Okay, we had news by 11 o'clock or 10 o'clock. I don't know why we had this big candle, but yeah, this is the manipulation leg, right? A fake move up, deceiving buyers to keep coming to the market. We see bullish PD arrays put on here as well. People have placed their buy orders inside this fair value gap here, expecting price to dip into it and trade higher, right? But we see price manipulates, then we see price distributes. Okay, we see price distributes. So this was the manipulation, accumulation for hours. For 4 hours, price was accumulating, price started distributing around 7 a.m. in the morning up to 9 o'clock a.m. New York time. And then we saw price started distributing around 10 a.m. right? And this distribution had a target. What's the target? Can you see this trend line liquidity resting here? So if you understand what trend line liquidities are, I made a video on that as well. What's resting below these lows? Sell side liquidities. So we have price come sweep these sweep side liquidities. That's another example here. Accumulation, right? Manipulation. Or we saw price distribute. old target. This high that was created previously became the new target for price. Okay, so that is the sequence of the market, and I hope that makes sense to you as you watch this video. Okay, hope that makes sense to you as you watch this video. Now, what I'm saying is that you don't want to be here during this season. You don't want to be here. You want to find your entries and your setups within these zones. You can see favor value gaps here for continuation, right? Price retracing to favor value gap and then price distributed higher. Okay, so I want you to go back to your charts and find more examples like that. And until next time, happy trading.